Welcome back to CEO Money. I'm Michael Yorba, your host. Okay, Daniel Wachtel, founder, CEO, Harbour Capital Partners, on the show with us. Daniel, welcome.
Thank you, Michael. Thanks for having me.
My pleasure. All right, you're an expert business consultant. You've been helping clients with business planning, investment mergers and acquisitions, forecasting their financial future, I would imagine, and various aspects of business growth. Give me some more background on you for our clients and our people that listen to the show, and let's jump right into it.
All right, great. In 2004, I begged a small hedge fund to let me, intern/watch what they're doing, like my freshman year of college. And then I moved on to being an intern in the investment banking division at Stearns. Once that collapsed, I moved over to Oppenheimer as an analyst and a financial advisor. And then right before 2008, I moved to a hedge fund and an investment bank. And that's where I started to get the idea that I needed to help and guide, companies along, because a lot of the time it's just some of the bigger companies that get serviced, because a lot of the fees are so high that, startups or, just revenue producing companies can't afford someone to walk them through how everything is done from, start to their exit. And during that time, I worked at Merrill Lynch and Morgan Stanley.
Okay, let's get into what you're doing now. Those are some great accolades, and it's not anybody that gets into that rarefied air club that you just mentioned, going anywhere from Bear Stearns, Oppenheimer to, Merrill Lynch. But I want to know when and how you were to come about founding Harbour Capital Partners, how that came about, and then we can move on to some other questions that I really want to drill down on.
Well, the idea came to my childhood friends from Ocean City, Maryland, and we got together after a few years and decided to start a company called W Ventures. And as we were going along and trying to find clients, we realized that we weren't doing our best. We still had a lot to learn in the industry. So we said, I'd take a couple years off and go back to school and learn about entrepreneurship, business administration. And during that time, I lost my father, and a couple months later, my fiance. So it got really muddled. So we started for real in 2011. And that was the time when we really sort of hit our stride. And we've been doing it ever since.
All right. I have a lot of clients and people that come onto the show who are pink sheets, and they're small companies, they're startups, and they want to get to the Nasdaq. It's not an easy move. How do you help people do that?
It's all about building the company. And you're right, it's a difficult move. A lot of the times I'd like to move them into OTC, QB, QX as sort of like the minor leagues of the Nasdaq to get them to understand what they're going to have to do or on a smaller level. But if you want your stock to do well, you have to have a great company. You have to start building a great company, and the stocks will follow. Investors look for improving growth rates, improving cash, lowering their cash burn, just seeing how they handle the money, how their multiples are. So if you are continually growing your company, then you'll be able to eventually get to the Nasdaq, because the filing fees on the Nasdaq alone are upwards of $1 million. So you have to be able to be fiscally ready to handle that sort of leap. And going from the pink sheets directly to the Nasdaq is very, very difficult.
That's that's a real understatement, because it to some people it's just, you can't do it. It's just insurmountable. But getting there, building that platform to get there, you've got all kinds of alligators and anacondas you've got to wrestle with. I talked to people today. I was talking to one guy today that's working to get his stock to a stable 250, so we can get listed and get uplisted. But you have all of these people that come out of nowhere that want to short the stock because they can make money doing that rather than buy it and get in for the long run. What advice would you give somebody who has to fight that battle?
Short, having those short sellers, never easy. But if you can weather that storm and just focus on the business, then you're going to eventually, you're going to squeeze the short sellers out. So if they're putting pressure on the stock, but the stock continues to move forward, and now you're having people buy the stock, they're going to get their shorts called away, and it's going to just put a short squeeze on the company.
So I get it. Stick to the plan, stay the course.
Just always stick to that long-term plan.
Got it. What other services do you provide for people looking to move their company from where it is to where they want it to be?
Some of the things that we provide are strategic due diligence. If it's a merger, acquisition, divestor, or a spinoff, marketing and branding strategies, sales and channel effectiveness, product pricing, consumer insights, so you know what your clients are thinking, business process redesign, strategic branding, and marketing, digital marketing, and your normal run-of-the-mill marketing. We want to build the company from the ground up, and then we can worry about the stock later.
Okay. All right. So really, you focus on the plan and the people, and then the stock is just a result of everybody doing the right thing at the right time. That's what I'm kind of getting from you.
Exactly. You see it on your blue chips. There's not a lot of companies that are continually losing money quarter after quarter that are going up. It's usually the companies that investors perceive are going to be growing in the near future, think of Tesla, or it's companies that are growing quarter after quarter, think of Coke. So they don't invest in companies that aren't going to be doing this or being thought of doing this in the future. So, they are the ones that look at the company, figure out how to continually sustain their profitability, how to grow their profitability, and the stock will follow. Investors will see that, and they'll move towards that stock.
All right. Now, we've only got about a minute left. I want to get into the vetting process on the next segment, but for this segment, the difference, what sets you apart, Harbour Capital Partners, apart from everybody else that says they can do what you say you can do.
It's simple. We've been there. We know what it's like, and we actually really care about the client. It's not just we want $30,000 a month as a retainer. It's it doesn't matter at the moment. If you are passionate, if you are looking to actually grow your company, and if you're in it for the long term, and we can feel that, we'll try to help you as much as possible. We'll figure out a way to actually help you instead of just being that run-of-the-mill Wall Street firm that doesn't really care about their client.
Got it. All right, Daniel, let's take a break right now. We'll get into the vetting process on the other side, all right?
Okay, great.
We'll be right back with Daniel Wachtel, founder, CEO, Harbour Capital Partners. Segment brought to you by Tycon Partners. You're listening to CEO Money with Michael Yorba. Don't forget, follow us on all of the social media, LinkedIn, Instagram, Facebook, you name it. We'll be right back. Welcome back to CEO Money. I'm Michael Yorba. All right, we're talking to Daniel Wachtel, founder, CEO, Harbour Capital Partners. All right, Daniel, when we left off, we were going through the different things that you do for people to help them move up the chain and finally get onto the Nasdaq. But one of the things that you've got to do before you can even give somebody the hope to move forward in the path that you're mapping out for them or you're clearing for them is the vetting process that you've got to go through to make sure you've got something real you can work with, and your investors that come along behind you to see you as okay, I know when I get something from Daniel, it's the real deal. Talk to us about that.
Well, it's an interview, just like anything else. It's us interviewing them interviewing us. But a lot of it is that we want to see the business plan to see if they are, if they're clear on their goals. Secondly, it's about the process, their values, their vision, how passionate they are about their company. There's not a whole lot you can do with somebody who's not passionate about making a successful company. So we go through their business plan and deck and just interview them to kind of get a feel of where they're at with their company. And if it feels right and they are, that they're telling you, the truth about everything, and they're able to be coached, then that's something that we move on with. If not, then we would try to help them find someone else that could help them. But we want to make sure that we all have the same values going in, and we all know what the end goal is.
Got it. All right. What about size? The type of clients that come to you, are they one- or two-man operations? Do they need at least 100 employees? Do they have to have more than 3 years of audited reports under their belt? Guide me through this.
Honestly, we will help anybody that truly needs the help. So it can be startups. It can be, the multi-international companies. It could be really anybody. We do get a lot of startups, a lot of just pre-revenue companies or companies that have just started getting their revenue. But most of the time, it's just people. It's just like any other enterprise. They need capital, and they're looking to us to guide them to different areas where they can get the capital to grow their business. And with that being said, we'll help anybody if they fit that criteria that I mentioned before.
Okay. When you say capital, because there's all kinds of capital. There's friends and family, there's incubator, there's first round, all the way to a complete liquidity event at the end, on the other end. Where do you come along, or do you come along in all different phases of this?
We'll come along with it in all different phases. It really, that's where the business plan and the goal setting is really, really important, especially if it's the angel, seed, funding. It's because a lot of times they'll go to their friends and family, and their friends and family are obviously going to say, "That's a great idea. It's the greatest idea I've ever heard." But as somebody who gets deals, 10, 15 times a day on their desk, you start to get an idea of what may work, what's not work, what industry is sort of hot, and what is never going to work ever. So we'll guide them, we'll coach them, we'll talk to them about maybe working on their business plan here or working on their business plan there, and that's where they'll get funded. We try to steer away from venture capital. It's just they take so much equity, and they really don't help in the process of raising money. They may give you some capital, but they want so much in return for it. So we really just try to stay away from that area because we don't believe it's in the best. We don't believe it's best for our clients.
What is your assessment of the market right now? Because I know you see all kinds of deals coming across in a variety of sectors, but you also get a pulse of where the dry powder is either there or not. And I'd like to hear your thoughts on that.
Well, the market in and of itself is what I believe it's overvalued. It's a federally mandated bubble. Since they were doing quantitative easing, the Fed did 3 of them. Interest rates were so low that there was no other place to really invest your money to get any sort of return on. So that's why the market did so well. And there are certain areas in the market, like tech, that are in bubble territory. But, the Dow, S&P, and the Nasdaq, I believe, are all overvalued in certain instances. But as interest rates are rising, you're starting to see some of the asset classes come down, and the multiples start to come down. So there may be some areas to invest in, but I see a large correction, if not a bull market, within the next year or two, as the Fed continues to raise rates.
I've got a guy named Mike who's a contributor onto our show, and his process is a 90-10. He's very bearish on the stock market. He thinks we're going to have a prolonged pullback, well past 2020. But the 10% is in private equity, high-risk ventures, and the 90% is in short-term duration bonds. I guess you could ladder them out as they go along. Is that kind of where you're coming from? Because you just mentioned you thought we're in for a pretty good pullback. You got to move the money somewhere.
Right. In 2013, when the Fed said that they were going to stop doing quantitative easing in 2014, they never really did stop it. They were just reinvesting it. So I believe as they actually do stop with the reinvesting of the treasuries that they have, and they really start ramping up on the yield or the interest rates, that your best bet is to go into debt instruments, short term, but like you said, you can ladder them out.
Right.
But I would stay away from the stock market until you start seeing value in certain stocks. It's just you're getting to the point where the stock market really can't go that much higher, so it starts to become a risk as you continually invest in the market. So I'd stay away from real estate. There are some very good private equity deals that you could invest in, but as stock market as a whole, I would really just cut back on your investing and start moving to different asset classes. Stay away from growth, stay away from doing large caps. Move more into value. If if you have a 401k or just start moving into different asset classes.
All right.
So I do agree with some of the demand you do have on.
Okay. Well, Daniel, real quick, we got less than a minute left. The growth potential for the listeners, any particular market sector that's sticking out right now before we close?
I don't really see one particular area. I mean, if you want to say tech, you could argue tech, but the valuation of tech are so high, and any type of the industrials, they're also very high. You're seeing Ford now cutting their cars down to 2. There's an obvious reason why. They are with Tesla. They are being valued as a tech company instead of a car company, which is another reason why I think Tesla is grossly overvalued, and I believe Musk should be removed. But
Daniel,
I don't see an area where there isn't a tremendous amount of risk to go into. right now, you're going to need a solid pullback before I would feel comfortable telling any investor to move into equity.
Got it. Daniel, we got to go for now, but thanks for being a guest on the show. Really appreciate that.
Thank you, Michael. I appreciate it.
My pleasure. Daniel Wachtel, founder, CEO, Harbour Capital Partners, harbor-cap.com. Segment has been brought to you by 720 Strategies. All right, you've been listening to CEO Money with Michael Yorba. Don't forget to follow us on all the social media, LinkedIn, Facebook, Instagram, and also Telegram. All right, we'll be right back on the other side of this break with our next guest. It's going to be Kurzai Solomon. We'll be right back.